welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I don't think this is at risk again of the labor market just turning over. We're just going to remember, we only need to have about 100,000 a month to keep the unemployment rate stable. The 4.2% unemployment rate, well guys, this screams 25 basis points at the Fed. This report doesn't scream 50 basis points right on its surface.
This report won't push anybody off their prior position. If they're those who are leaning toward just moving more slowly at 25 basis points, there's enough resilience in these numbers that I think keeps that in play. Although I think, the 50 basis point camp, which, as you said, the market in reaction to these numbers is thinking is slightly more likely now. I think that, does come into play with those downward revisions.
Clearly, the street wasn't happy. They were looking for some sort of outsized number, maybe 13 plus, the whisper number. The same thing happened with NVIDIA, came up with a pretty significant guidance upside. But this is a little more of a story about the diversification of the business as well. So the AI business is performing. You're going to have some complicated networking that Broadcom is going to help solve. And of course, these accelerators, these AI processors.
We got 1 hour to go until the market close. So we're taking a look at the major averages, which are selling off because guess what? Bad news is bad news. Bad economic news in the form of the jobs report translating into a negative reaction here. So let's run through the numbers quickly and then we'll take a look at the jobs numbers. The Dow right now down about 370 points, about 0.9%. The S&P down 1.6%. And as you can see, the losses sort of accelerated through midday and then have been going sideways. It's also worth mentioning here, it's the fourth down day for the S&P, the longest losing streak since April, the worst week for the index going back to March of 2023. And guess what? For the Nasdaq, which is now down 2.4%, if you see this 4.5% decline, it looks like it could be the worst potentially going all the way back to 2022, to January 2022. But we'll see how everything shakes out when all is said and done. But as I say, all of this based on those jobs numbers, Josh.
Yeah, it was interesting. The economist Stephen Stanley today, Julie, he kind of looked through the report and then gave his clients his take. His take was what was kind of like, there was sort of something for everybody. In other words, his point was, if you were looking for weakness, you got it. August gains 142,000. That misses. The downward revisions you saw, by the way, significant, 86,000. On the other hand, Stephen was telling his clients, in his opinion, when he kind of looked under the hood, virtually everything else he said looks solid. So a mixed report. I think you saw a lot of that kind of playing out in today's trade.
Yeah, the unemployment rate was part of the other side of the equation, right? So what does all of this mean for the Federal Reserve? That now is becoming the big question. And we were seeing a lot of fluctuation in these numbers today, Fed funds futures, and where they're pricing in the chances of half a point cut compared with the quarter point cut. Right now, the quarter point wins for the moment, but that was bouncing around a lot in today's session. But right now, it stands at around 73%. Quarter point at around 27%. But if we go back over to what we've been seeing in markets here, it's pretty broad-based. The equal weight index not down quite as much because of the preponderance of tech, but it is down about 1% in today's session. The Russell 2000 down by almost 2%. You've got volatility up, which you would expect. You have got yields down. Not down huge, but down to 3.71% here. And then if you look at across other risk assets, oil, for example, is also lower. But I also want to check on the sectors here because here too, you see a broad-based sell-off here. Almost all of the groups in the S&P are down, except for consumer staples, actually up just a hair, a smidge.
Nice defensive play. The other thing to learn too is the chips today were really interesting, I thought, Julie. Obviously, Broadcom reported, we broke that as they crossed yesterday and got absolutely whacked today. You can see that nearly 10%. Now, to be fair, of course, heading into that print, as we mentioned, had a very strong run.
Yes.
A lot of people had moved into that because, of course, they saw it as a smart AI play, but you saw that really dragging down the sector. The SMH, last I checked, the ETF that tracks the chip, it was down about 4%.
I mean, all of these stocks are down within the group. NVIDIA as well, continuing its sell-off here, and that too accelerating through the day. I just wanted to look at what we've seen thus far in September and that sort of or I should say over the past month, and this sort of round trip that we have seen for NVIDIA as it has continued to sell off.
All right, let's get into more perspective on today's jobs data and the impact on the markets moving forward. Let's get to Emily Rowland, John Hancock, Investment Management Co-Chief Investment Strategist. Emily, always great to see you. So let's get right to the news today. Emily, what did you make of that jobs report, and what do you think it means for the markets?
Well, it took the markets a long time to figure out what everybody's been making of it. It's been a bit of a wild ride, and Julie pointed to that today. I think ultimately the report was weak. 142,000 is not too bad, but then those major revisions of 86,000. There were a couple of bright spots in the employment report, but I think weaker economic data was interpreted by the markets to be weak. And you're seeing that. The other element at play here is NVIDIA. And when NVIDIA is down, it's going to bring the market down. And then you have Broadcom into the mix. So some weakness in tech here. We did see massive multiple expansion in that space. So I think pretty reasonable that we're seeing those names take a bit of a breather today.
Yeah, and we should mention when it comes to the Fed as well, we heard from both Christopher Waller and John Williams today pretty much saying, yeah, it's time to cut. We still don't know by how much. Does it matter by how much from an equity market perspective? If we get a half point cut, for example, does that show the markets that the Fed is worried?
Yeah, I mean, I think 50 basis points would show that maybe there's something that the Fed knows that we don't know as far as a recession coming. Right now the economy is decelerating, but at a nice, easy pace. We're seeing a lot of mixed data. Just this week, for example, job openings fell to the weakest level since 2021, but initial jobless claims came in really low. You saw ISM manufacturing take a move lower, suggesting contraction, but at the same time, ISM services remain buoyant and actually increase. So we want to, I think the Fed wants to make cuts sort of surgically here, move slowly. They don't want to spook the markets, I don't think, by going by 50 basis points here. But look, we have another inflation report coming up, more data to come on the labor market. So we'll need to see what happens here on September 18th.
So your playbook for the stock market then, Emily, what would you be advising? What would you be telling clients?
Yeah, we're advising that clients just don't reach too far for risk. We still want to be invested in this market. And at the end of the day, stock prices are going to follow profits or follow earnings. And the earnings backdrop's just fine, if not quite good. So we want to continue to be invested here, but we're seeing cyclical areas catch a bid. The weaker dollar has been helping riskier cyclical parts of the market like international equities. We really want to focus on quality here. These are companies with great balance sheets, lots of cash, great return on equity. The poster child for quality is mega cap tech. We like that, but we do have a valuation issue there with the tech sector, bumping up towards 30 times forward earnings. So we want to look at other areas of the market, quality at a reasonable price, if you will. So looking at sectors like healthcare, which are trading at a 10% discount to the broad market. And we're starting to also leg into more defensive areas of the market. Utility stocks, for example. We're looking at infrastructure related assets. We do expect to see a big shift in the consumer as people potentially push away from buying the things that they want to buy. Please tell my children I said that. But they're going to still do the things that they need to do. So we think that those more defensive areas of the market deserve a look in portfolios. I
want to come back to tech for a moment. When you say quality at a reasonable price, what would be a reasonable price? Because obviously the sector's come down. How far down would it need to come for it to look a little more reasonable to you?
It's a great question, but the challenge is that valuations have never been a great catalyst. I mentioned the tech's bumping up on 30 times forward earnings. The valuations are elevated, but the earnings are elevated too. And frankly, the denominator has mattered a lot more to us. And you look at earnings for this quarter, the technology sector generated about twice the earnings results as the S&P 500. Revenue growth was concentrated in a handful of technology names. So we still like this part of the market given the elevated earnings trends, but we have to recognize that they're overbought as well. So I think it wouldn't be unreasonable to see a little bit of steam let out, but what I would really be watching for to underweight the sector is if there was some big shift in earnings dynamics. and we're just not seeing that yet.
Emily, can I get your thoughts on the AI trade as well? I asked because Broadcom reported. I think there were some who were hoping Broadcom was going to report and ride to the rescue. And after all, a lot of folks had moved into Broadcom because they saw it as a smart way to play that trend. But it did report, and right now we're down about 10% here, Emily. And just your thoughts on that mega trend.
Yeah, I mean, it's the same thing with NVIDIA, where the earnings results were decent, but they almost had to be amazing to get investors to continue the excitement around some of these stocks. There was a lot coming into the price going into this earnings season. Again, really driving the market higher and seeing that multiple expansion. So, I think it makes sense here that these names are taking a little bit of a breather, but we still want to own them in portfolios given the high quality nature and the earnings drivers that are inherent in the space.
Emily, I got to get in a bond question. So let's talk about how you're currently thinking around the Treasury market specifically here, right? You would think the Fed's cutting, yields are going to come down. They have come down some, right? But kind of within a range here. So what do investors do with that?
Yeah, Julie, we would be looking again at every backup in bond yields as an opportunity to lean into high quality bonds. We still see the income as very attractive. In bonds, the aggregate bond index now yielding about 4.25. What we do see, there's this debate going on today about 25 versus 50 basis points for the Fed. That's cute, right? The Fed normally, on average, cuts 17 times, and the 10-year Treasury yield falls on average 2.5% to 3% during those periods. So we want to be looking at the total return potential that it's inherent in bonds, not only from duration, but also from the income. We might have to wait a little bit for the duration part to kick in, but you can get paid to wait, given that income is near the highest in over 15 years.
Emily, great stuff. Always good to see you. Thank you. Appreciate it.
Me too.
Well, Qualcomm is reportedly exploring the possibility of acquiring portions of Intel's design business. It's according to a report from Reuters. For more on how this could affect the chip industry, let's welcome in Yahoo Finance tech editor Dan Halley. And Dan, obviously there are kind of two sides to this. There is the ongoing story of Intel's struggles and what it's going to do about it. And then there's sort of the Qualcomm side of it and what it stands to gain. So talk to us about how you're thinking about this story.
Yeah, just to level set, nothing's confirmed here. Nothing out of Intel, nothing out of Qualcomm. But it would be a wild story, right? The PC side of things is still Intel's biggest moneymaker, and so if it ended up selling it off, it would be a completely, out of the blue almost move on their part. At the same time, they're struggling to kind of right the ship, right? They've been turning it around. Pat Gelsinger has this massive plan. They rolling out 5 nodes, I believe in 4 years is what they were doing. They have the foundry division that they kind of separated off and now is its own reporting area for their earnings. They're still their own biggest customer, though. Microsoft is reportedly going to be working with them on a specialized chip based on Intel's 18A platform. And frankly, they're still far away from NVIDIA as far as catching up on the AI side of things, though they do offer CPUs, and people do use their CPUs for data centers. So that's the Intel side of things. On the Qualcomm side of things, they've been creeping into the PC space for quite a bit. They haven't done so successfully, seemingly, until now with their new Snapdragon Elite line of chips. And so those essentially can run Windows PCs, laptops really, and provide the kind of power and performance that you might expect out of Apple and its M line of chips. So that's really kind of where they stand now. And if they move deeper into the PC business, you can only imagine what it would mean for them and their expansion. They're primarily known for building chips inside of smartphones, but smartphone sales aren't what they once were as far as upward trajectory goes. And so that would be a huge move for them. A few other kind of caveats here. Intel did just announce a new chip, their 2nd generation Core Ultra line of chips that they say beats out Qualcomm's new PC chip. And so they're basically saying, okay, we have to put out a chip that puts performance and power on the same playing field. And they claim to have done that now. So it kind of leaves you to wonder, well, will they continue to then move forward with the PC side if they have this chip that supposedly is a wonder chip and puts them back on a par with the likes of Apple and Qualcomm and AMD, or do they just jettison this massive part of their business? So, again, this is still a report. There's nothing from Intel or Qualcomm to indicate that they're moving forward in any way with this kind of deal. But, as you said, Julie, this would be a wild shakeup in the chip industry.
It would indeed. I mean, and already it's been a wild shakeup for Intel. I was just looking here. Intel's shares trading at their lowest since November of 2010, Dan. So obviously investors think it needs to do something. So really appreciate it. Thank you. Well, we're just getting started here on Market Domination. Coming up, the recession debate renewed on Wall Street, whether the noted Sahm rule has been triggered, and it has. We're going to speak to the woman behind that indicator, Claudia Sahm, on the other side, for her latest thoughts. Stay tuned, much more Market Domination still to come. The U.S. economy adds less jobs than expected in August. Meanwhile, job additions for June and July were also revised downward. So the question of a recession lingering as the Federal Reserve prepares for its next interest rate decision. Here to discuss, New Century Advisors chief economist and former Federal Reserve Board economist Claudia Sahm. Claudia, it's always great to see you, especially on Jobs Day. So first, just wanted to get your high-level take here, not just on the jobs numbers, but what you think the Fed is now likely to do.
So the latest information that we've gotten about the labor market is not good. It's not terrible, but things are slowing down. They're pointed in the wrong direction. And it is absolutely clear what the Federal Reserve needs to do right now. The labor market is slowing down in part because of an intention by the Fed to slow things down, to get inflation down. But I mean, the effect, and we knew this was coming, was the labor market would slow down. And it's time for them to ease off, right? Like, this is getting to a place where these numbers, while they're not recessionary, these aren't good. And we're really, the labor market that has been great for the past years is starting to really slip.
So, Claudia, would you recommend, a traditional 25, or do you think 50 is warranted given the data you're seeing?
Given the data that we have seen since the July FOMC meeting, right? So we've learned a lot in the last 2 months about the labor market. A 50 basis point cut would be appropriate and warranted as a recalibration. Right? We've not just gotten two disappointing jobs reports, we got a large preliminary estimate of an annual revision to payroll gains. Things have been slowing down much more, both in terms of there's less job creation, and the trend is worse, looks worse than anybody could have known sitting in July, looking at the data. So there is an argument to make, hey, we should have got going. We're going to do a little bit of catch up and then go ahead. It is not a 50 basis point in the bottom is falling out, the recession is nigh. It's just, hey, things are slowing, and we misjudged how quickly they were slowing, and we're going to get on top of it. Because again, the federal funds rate is over 5% right now. 50 basis points is not the first cut that needs to be done. We have a whole series, and it's better to start moving with some real purpose here and respond to the data, to what we're seeing in the conditions, because the labor market will continue to soften.
Claudia, I want to ask you sort of a wonky economist data question. So stick with me here for a moment. And this was brought to our attention by Omar Sharif of Inflation Insights. His comment was picked up by Sherwood. They looked at he's looking at the 3-month average of payrolls over the last 3 months, including today's revisions. And that 3-month average is now 116,000. But if you look at this little note that he pointed to in the BLS, which, to be fair, I never noticed before, they are 90% confident that the job number is correct within a range of something like 130,000. So 116,000 is less than 130,000, which I guess means that there is a chance that there was actually, it's probably not a big chance. I guess what I'm getting at is, to your point, there are so many revisions. How do we read these numbers when there is such this range and all of these revisions?
So we need to understand the data are imprecise. They are subject to revision. Revisions are a sign of how high quality our data are. Like, we get numbers really fast, and we have statistical agencies that put effort into making sure that over time they get better and better and more accurate. Right. So, but that means that when you're doing decision making in real time with the imprecise numbers, you do things like take the 3-month averages, look across different series. It's not just about payrolls. It's not just about unemployment rate. You really have to breathe it all in. And one thing that I think particularly that I have spent a lot of time looking at now are, like, what are the contours of the data? Right. What Powell told us in Jackson Hole is they don't want to see further cooling. Right. Like, what's the direction of travel look like? And so you try to move away from, there is no magic number. Right. And to make policy or to make an assessment of the U.S. labor market or economy in general, you have to look at lots of different pieces of data. And yes, being very aware of these are imprecise numbers and they will change, but you got to kind of high level.
Yeah. Claudia, given what you saw in the report today, interested also to get your updated thoughts on the state, the health, the resiliency of the American consumer here, Claudia. We're always looking for clues. You go through this earnings season and you listen to the CEOs and the CFOs running our companies, and I think there was a note of caution. You heard a lot of talk about a consumer that's selective, right, discerning, focused on value. I'd be interested to get your take.
Right. When we see something, so I think for the consumer, you will continue to have that theme of some uncertainty, some caution. We see that with employers too, in terms of their hiring decisions, right? And this isn't just about the Fed that's weighing on people as they kind of think, what's the next move? But with the labor market slowing, and again, it is not in a crisis place, but as it slows, the labor market is so important to most American consumers in terms of their spending patterns, particularly their ability to go out and make the big purchases, spend more. And so right now, if you have a labor market that's doing okay, but slowing down, like, again, the direction we're headed here is not a positive one. And it doesn't have to, like, the recession is not the only bad outcome that we could face. Just something slowing down, that is its own, I mean, that's something we want to try and avoid as well.
Something we have been talking less about, usually the discussion is sort of binary, recession or no recession. But you just touched on something, which is, what will the recession look like? One of the things I was looking at, in addition to looking at the SOM indicator, of course, was just looking at the absolute unemployment rate going back in recessions in the post-World War II period. Usually, particularly in the last, say, 40 years of recessions, the unemployment rate is not quite as, it is less benign than it is right now when you head into a recession. So does that imply that if we do go into one, it won't be as severe, or that if there's a slowdown, it won't be as severe? Like, how do we get the color on the recession, if you will?
I would caution against any analysis that really hinges on the level of the unemployment rate. So when we think about, tracking the recessions and the work I did with the SOM rule, it was all about the changes, because we have gone into historically recessions at very low unemployment rates, and we've gone into a much higher unemployment rates from now. A reason why a fairly low of a 4.2% unemployment rate, that is historically, you point out, that's a good number. Well, we also have a much more experienced and older workforce just by demographics. We would be expecting, and like Congressional Budget Office is one that does estimates of this, we would expect an unemployment rate to kind of, if everything is, in equilibrium, all doing fine, to be not that much higher than where we are. So whereas in the 1970s, when we had a much younger workforce, that rate was much higher. So you have to be careful about those levels. But this idea of, I think if I were going to point to where we are better positioned to buffer some of the stresses that you might see in a recession or a lot more weakening in the labor market, we do have households that tend to have better balance sheets. Not all households, but in relative position, we have come to this place with, we've had some good jobs, good incomes, wealth has been higher coming in. So I'd look at that piece of it as opposed to, the level of the unemployment rate relative to history.
Point taken. Claudia, always good to catch up with you. Thanks a lot. Appreciate it.
Great. Thank you.
All right, let's get to some of today's trending tickers right now. And by the way, throughout the trading day, you can track the best and worst performing stocks of the session on Yahoo Finance's trending ticker page. You can scan the QR code below in order to check them out. I want to start, though, in terms of the actual trending tickers with the Smart Sheet. Interesting story here, because the company came out with its numbers, and that was today. This is after yesterday there was a report that they were in talks with Vista and Blackstone to potentially get acquired. So yesterday the report came out sort of midday. The stock went up abruptly. You can see that on your screen, 1 p.m. yesterday. Then they reported earnings and they took another leg up, Josh.
Yeah, and then so with this report, private equity group moving in, this is per Reuters, includes Vista, Blackstone, talking about buying Smartsheet, maker of workplace collaboration software, corporate clients like Pfizer, Julie, other Fortune 500 companies, American Airlines. Reuters says deal could be signed in coming weeks. Terms, it doesn't sound like, though, immediately apparent.
Right, and then the company's numbers came in ahead of estimates. Annual recurring revenue, aka subscription revenue, rose by 17%. And it also had a net retention rate of 113%. That's on a dollar basis. The number of customers with annual recurring revenue of 100,000 or more was up by 24%. So analysts liking those numbers as well as the potential for an acquisition.
Yeah, most on the street is positive on this name. I mean, including the team at Jefferies. They looked over that print and said positive early response to new pricing and packaging. The guide, in their opinion, looked conservative and still some firepower they point out left in the buyback plan here. Moving on, take a look at UiPath. Those shares under some pressure despite delivering an earnings beat in the second quarter. You see they're down about 5%. Software company offered a full year revenue forecast that clocked in ahead of forecasts. Most on the street neutral on this name, even after this stock has been shelled, Julie. It's down about 50% this year, but I know you did some digging as well.
Yeah, I emailed with Gil Lurie over at D.A. Davidson, and he said he didn't really see any problems with the quarter. He said the quarter was strong here. It did fall, to your point, earlier this year after it cut its guidance and announced a CEO transition. And he said, you know, the quarter here, they slightly raised guidance. So it was what he called mildly impressive that they raised the numbers. He puts the decline today perhaps down to the broader sell-off that we're seeing within technology, maybe pulling them down.
Yep. I know KeyBank, one of those names on the sidelines, here's what they told their clients. Is it encouraging to see UiPath return to beat and raise cadence, but maintain a sector weight rating, they said, as we look for the company to rebuild its execution track record.
Yes, we'll see what happens. All right, Toyota reportedly trimming its electric vehicle production plans for 2026. That's according to the Nikkei Business Daily. Toyota taking part in a growing list of automakers that have been adjusting their EV goals. And Yahoo Finance's Prasad Gramani, of course, has been tracking those companies. I mean, this is definitely a trend that we have been seeing, and Toyota just the latest.
Yeah, not a surprise here given what's happening, and even Toyota's stance with them kind of being cautious with the EV sort of transformation globally, not surprising here. So according to Nikkei, they're cutting their global EV forecast to 1 million by 2026. That's down 30% from what they saw last year. They're also seeing 400,000 EVs sold in 2025, which is actually a big amount considering they only sold like 80,000 last year. So they see it growing, just not as fast as some had thought. This is sort of the overall big trend we're seeing. Cooling off, still growth, but nowhere near what people expected. And we have a chart here of some of these other companies and what they're seeing. GM pushed back their sort of model there for EV sold by 2024 several times here. Ford pushing back investments on its factories and also cutting some EVs that they were going to actually come out with. Stellantis putting battery plants on hold, and even Volvo is saying that they're not going to go full EV by 2030. We have a mix of hybrids and power plants like that for basically an indefinite period.
And Toyota, to go back to Toyota for a second, they were sort of a pioneer of hybrids. We've seen a lot of the U.S. automakers refocus on the hybrid strategy. Is that something that Toyota is doing as well?
They've been doing it for over 20 years with the Prius, and they say
it's amazing to think about that.
Yeah, and they say that we're going to keep doing this because it works for our customers. They claim that one hybrid takes one regular EV, you can use basically make 90 hybrids out of it in terms of the number of battery components. So it's way more efficient. They can build more EVs that way, and that's what their customers want. That's what a lot of customers are saying in the U.S. is that hybrids are what they prefer, and I think that's where Toyota's going to go and keep staying there for now.
Interesting.
All right, thank you, Pras. Appreciate it. Coming up, Google heading back to the courtroom next week to break down everything you need to know ahead of its latest clash with the Department of Justice. Next, stay tuned. More market domination still to come.
OpenAI reportedly surpassing 1 million paid users for corporate versions of ChatGPT, signaling growing demand from businesses for its chatbot despite competition from other AI players. And this coming after news that a new round of funding for OpenAI, led by Thrive Capital, could value the company at over $100 billion. For more, we're bringing in Jeff Lewis, founder and managing partner at Bedrock, which has among its investments OpenAI. Jeff, thanks so much for being here. Appreciate it.
Great to be here. Thanks for having me.
So what do you make of that latest sort of metric on the, in terms of the million users on the business side? And what do you see as the sort of growth trajectory for something like an AI, particularly when it comes to business users?
Feels like it's really still just starting out at this point. So obviously a really impressive milestone. The revenue numbers under the hood are frankly even more impressive. Obviously can't share specifics given we are large early investors under NDA, but was publicly reported in June that OpenAI was at a north of $3 billion, around a $3.4 billion revenue run rate, grown significantly, of course, since then. For really a business that's only been a business for less than 2 years, I think it's easy to forget that ChatGPT launched less than 2 years ago. This organization has only been monetizing for under 2 years. And so the million user metric is great. The revenue metrics are great. Truly just getting started. I don't think we've ever seen growth like this in under 2 years. It's pretty exceptional.
Jeff, let me ask you, I had a chat with a buddy of mine today. Like you, Jeff, smart guy, like you, he thinks a lot about tech, like you, he's in Texas. And he said, you know, he would invest in OpenAI, and I thought that was interesting. I asked him why, and he said there's a number of reasons, he said. And one is, though, he was curious about what exactly is this company's moat at this point. And his point was he gave the company a lot of credit for helping to create this market, helping to create a sense of excitement and urgency around the market, Jeff. But now his point was, you know, Google's in, Microsoft's in with their own models, AWS, and just the gap is narrowing, he said, at this kind of accelerating pace. It felt to him like an uncomfortable position for Sam Altman to be in. Your thoughts, Jeff, on that argument, just as an early investor?
Certainly the gap has narrowed. So I acknowledge the gap with the current models that they have in the market today versus some of the competitors. The gap has actually narrowed. That is true. I think whoever you were chatting with, who's not an investor in OpenAI, and I think I have a guess of who that was, I don't think they're an investor in any of these AI LLM companies. The gap is going to widen significantly when you see what they've got coming next. And so I think there is a moat around tech. There also are lots of extraordinarily valuable technology companies that really just don't have any technology moat at all. They have a distribution moat, they have a brand moat. And I think you have a situation with OpenAI where beyond the tech moat, which I think you're going to see in the coming quarters, they're going to regain in a pretty profound way. I have high confidence in that. Beyond that, though, I think they have a brand moat, they have a distribution moat. I think the partnership with Microsoft, as well as the forthcoming partnership with Apple, as well as other partnerships they've been reported in terms of integrations, really give them an advantage versus the competitors. That said, there are players like specifically Anthropic that are just extraordinarily aggressive in trying to really come after OpenAI's lead. And so we should be watching that very, very closely at this point, Anthropic specifically.
Hey, Jeff, you want to give us a hint about what's coming? You've referred to it a couple times that you're very excited about what's coming. I mean, if you can't tell us exactly what's coming, where is the differentiation tech-wise going to come? Right? You said these other companies have brands. Microsoft, obviously well-known, very entrenched with business customers. Is it just like you get better answers? It interacts better? What's the, now that the leap has been made that it exists and people interact with it, what's the next leap look like?
Yeah, I really want to be able to tell you. Unfortunately, I know how lame and cringe it is to not answer the question, but I'm under an extremely strict NDA, and unlike that Texas gentleman, I don't want to lose the shares that we at Bedrock have in this company. So I'm not going to violate the NDA to give a good talking point on Yahoo News. I'm so sorry, but I would love to.
Well, next time, Jeff, we'll try again. What does, Jeff, I'm curious, as an investor, what does an exit look like for you?
I mean, look, I think this is a company that'll probably be private for some time. If you look at a business like SpaceX, that's been a private company for, at this point, I think, coming up on 23 or even 24 years, or maybe 22 years or something. And you as an investor or an early employee at SpaceX can get liquidity on a quarterly basis through a tender offer process. OpenAI, I imagine the same will be true for many years to come. I'm sure they've been running tender offers, they've done a few of these. I imagine they're going to continue to do those on a semi-frequent basis. There's going to be liquidity there for folks. But at Bedrock, we hope to hold OpenAI for over a decade from here. So hopefully, knock on wood, there's not an IPO for a long time, because I think a lot of value can accrue in the private markets. But if you just zoom out, if it was a public company today, I think the public would value OpenAI at far higher than $100 billion. And so, there's all this talk of that seems crazy, $100 billion. But if you ask sort of a person at a shopping mall on their iPhone what ChatGPT was worth, they would probably think it must be like $1 trillion, or it must be like $100 billion or something. So the valuation in the context of the public, I think, if it was a public company, might be a much higher valuation today.
Jeff, with so many, OpenAI is obviously not the only privately held company. You mentioned SpaceX. To see these huge increases in valuation, from a VC perspective, are you seeing any starving on the lower end of the ecosystem? Because there are so many, forget about the unicorns, decacorns, whatever you want to call them at this point. Does that mean that the more innovative, smaller ideas are not getting the attention that they need?
Well, the innovative, phenomenal ideas are getting attention. The problem we have is there are just so many crap companies. There are hundreds of thousands of crap companies that were way overfunded. Most VCs, this is not any profound insight, are horrible investors. Most VCs are really just marketers and salespeople, and separate institutions and pension funds and endowments and sovereign wealth funds from their money and blow it all on networking events. That's kind of 90% of the VC industry. And, they're going to all blow themselves up, which is fine with us at Bedrock. But unfortunately, so many crap companies were so overfunded over the last cycle. And it's going to be a long unwinding. It's going to take a long time for these horrible companies, these horrible investments to go bankrupt or get acqui-hired or go to business. But it's going to be a long, slow, painful unwinding for the VC industry. And most VCs will be, they'll revealed for just being sort of marketing people, not investors.
Jeff, a final question. I feel like I remember you once saying, Jeff, correct me if I'm wrong, that in real estate, it was location, location, location. And with venture investing, it's founder, founder, founder. And I'm curious, when you first decided Bedrock was going to invest in OpenAI, how much of it, Jeff, was about Sam Altman and just your faith and confidence in him, his leadership, his execution?
It was 100%. I didn't, frankly, I've learned since that folks like Ilya, who started now his own venture, excited for him. Greg Brockman, who's with OpenAI today, currently on a leave of absence, but still with the company. Other folks there played a key role as well. But the only person I knew before we invested was Sam. It was 100% our view on Sam as an entrepreneur. And our start point and end point at Bedrock is the entrepreneur. That is what we underwrite here.
Jeff, always great to have you on the show, my friend. Thanks for joining us.
Pleasure's mine. Thanks for having me.
Google is heading back to the courtroom next week, the tech giant clashing with the Department of Justice again, this time to defend claims that the company is illegally monopolizing online advertising technology markets. For more, we're bringing in Yahoo Finance senior legal reporter Alexis Keenan. Alexis.
Hi, guys. Yeah, so back in court again. Openings start on Monday, and this is just on the heels a month after Google suffered this defeat in another federal court, calling its search empire a monopoly, an illegal monopoly. But here's what this case is about. It's really different from the search case. What the Department of Justice in 17 states are saying is that there are 3 advertising technology markets where Google is also an illegal monopolist. And mind you, these markets are defined by the DOJ, and this is something that the DOJ and the states have to prove up. They say these markets are the networks that Google owns, where advertisers buy space. They say that Google controls 80% 90% of that market. Also, the servers that publishers use to sell space for advertisements, DOJ says 91% ownership by Google there, and also the exchange where the parties meet to make these deals. Now, the DOJ says that Google either built or acquired to go across this entire community of tech services for advertising. And with it, they are foreclosing on competition, driving up prices. And one of the ways they say that Google is doing that is by blocking publishers from access to Google's advertising demand unless they use both the publishing server and Google's exchange. That's just one of the ways, but one of the major ways that the government is saying is a concern. Google, for its part, says, no, our suite of technologies are actually an efficiency for consumers, for advertisers, for publishers. And they say that the price per click for ads is down. They say that the publishing advertising revenue is up. So where's the anti-competitive harm here? Now, let's just talk, though, about how the advertising technology revenue for Google fits into the bigger picture. So as we know, big ticket item is the almost $8 billion. That's 77% of Google's total ad revenue. That encompasses search and the big picture there. But if we try to drill down, it's really murky to try to parse out exactly the ad tech space because Google doesn't give line items for that in its revenue report. So in 2023, network ads, and this is supposedly taking up part of the ad tech businesses, network ads, that was accountable for $31.3 billion of Google's total revenue, so roughly 10% there. Compare that to 2020. In court documents, Google revealed that they were bringing in approximately then $20 billion, so 11%. Not too far off there, but a decline would be in these more recent years. In 2023, revenue for YouTube ads, 31.5, if you want to have a comparison there, but still a significant amount of money, a significant revenue driver for the company, and the DOJ is asking for these companies to be broken up. Not specifically which one should go, but they say there should be a divestiture here.
All right, we'll be watching. Alexis, thank you so much. Coming up, we are looking at how to navigate the wide world of the internet with the Yahoo Finance Playbook. Stay tuned. Much more market domination still to come.
It's been a rough week for tech, with investors rotating out of the sector amid worries about AI, among other things, sending the Nasdaq tumbling to its worst week since 2022. And some investors do think there's still value to be found. And with just a few minutes left till the closing bell on Wall Street, we're looking at how to navigate Mag 7 internet stocks and beyond with the Yahoo Finance Playbook. Joining us now is Eric Sheridan, Goldman Sachs Senior Equity Research Analyst covering the U.S. internet sector. Eric, it's great to talk to you, especially since you are preparing for your big tech conference that is happening starting at the beginning of next week in San Francisco. And I know, among other things, you're going to be focused on the state of the global digital consumer. What do you want to, I mean, there's a lot of worries about the consumer out there. So what specifically are you going to be asking the CEOs at the conference?
Well, thanks for having me on. And yes, we're excited about our conference next week. I would say the most interesting area for us is how much nuance there is around the consumer. Typically, people want a good, bad, black or white answer with respect to the current state of the consumer. And what we're finding based on our research is that it's much more nuanced based on household income, goods versus services, elements of how you spend on discretionary versus non-discretionary items. So when we talk to CEOs and CFOs from companies like Uber, DoorDash, Airbnb, and Booking across travel and rides and food delivery, we think we'll hear interesting answers about the current state of the consumer. But broadly, we think the consumer, while slowing and normalizing in a post-pandemic world, it is not slowing or normalizing beyond the degree of what we already think in terms of our forward estimates. And to us, we don't think we're hurtling towards any sort of recession in terms of the digital consumer and the digital economy.
Eric, let me ask you another big trend I want your take on, which is AI. A lot of companies you cover, Eric, they're spending on AI, they're spending on this tech. Which companies that you cover, Eric, can you see an ROI on that investment?
Well, I think where you see a more direct ROI today is when you look at the cloud computing companies. So AWS within Amazon or Google Cloud within Google, which is where enterprises are experimenting and deploying AI at the enterprise level today. So there's CapEx that goes out the door to buy capacity from the semiconductor landscape. And then that capacity gets deployed and utilized into organizations like ours, where we're experimenting with AI and we're deploying AI at the enterprise layer. Where the longer duration ROI is still a little bit less visible is how it plays out on the consumer landscape. So I would argue that most consumers have the same internet habits today that they had 18, 24 months ago around the time that ChatGPT exploded onto the landscape. Typically, consumer computing habits change over very long duration periods of time. Think back to when mobile computing started and how long it took before people were talking about mobile smartphones as being the more normative practice of how they accessed the internet. So typically, it happens quicker on the enterprise side, and the hyperscalers or the cloud computing companies, it's translating almost immediately into higher workloads. So if you go back and look at the earnings results last quarter, AWS cloud revenue inside Amazon reaccelerated. Google Cloud revenue within Alphabet has reaccelerated over the last 2 quarters. That's where it's showing up immediately, but the consumer landscape could be taken over a longer period of time.
I think this is a really important point, Eric, and it also raises questions about what resources these consumer companies are going to be allocating to AI and with what cadence, right? So is that something that they're already talking a lot about? I mean, certainly the enterprise companies are talking a lot about that, but what about on the consumer side?
Well, look, across a whole host of names, you're starting to see AI be talked about in the consumer-facing dynamic. So I cover Alphabet. Google launched their Pixel phones in the last couple of weeks. They're talking a lot about Gemini. They're talking a lot about Gemini not only on their Pixel phones, but across the whole Android ecosystem. Apple, which is not covered by me, will have their handset event next week. Obviously, there's a lot of press reporting about Apple Intelligence and AI being deployed across the iOS ecosystem. You're now seeing advertisements talking about Copilot and AI services across the Microsoft landscape. So you're starting to see the bubbling up of advertising and showing the consumer what these services are, how they can use them, how they can embrace them, how they can work them into their day-to-day life from a computing utility standpoint. But we are still early innings on the consumer side.
Let me ask you, Eric, look at big tech. You got some buys. You like Alphabet. You like Meta. If I force you to choose, though, Eric, is there one that you prefer the most?
Currently, we believe the risk reward on Alphabet is more favorable than Meta from current levels. There's a lot of noise priced into Alphabet here. There's a Antec trial starting next week. There was a recent negative judgment in the search case with the DOJ that's now entered the remedy phase. There's a lot of debate among investors about how AI broadly on the consumer side, whether it be OpenAI or Perplexity or Anthropic, could disrupt the search landscape over the medium to long term. We don't see much changing in the search landscape anytime soon. We believe that the earnings power of Alphabet continues to have more of an upside node than a downside node, and the market could be missing a lot of the opportunity that sits inside the YouTube asset and the Google Cloud asset. So as a result of that, that's probably the most dislocated name in the sector right now. Therefore, there'd be a slight preference for Alphabet over Meta between those two buy ratings.
Eric, great to have you on. Thanks for your time and those picks. Appreciate it.
Have a great weekend.
You too. And a reminder, Yahoo Finance will return to the Golden State Monday, September 9th and Tuesday, September 10th for the coverage of the Goldman Sachs 2024 Communacopia and Technology Conference. Yahoo Finance's executive editor, Brian Sozzi, and Catalyst host Madison Mills will sit down with a stellar lineup of top executives from AMD and AWS, as well as leading analysts in the tech sector. And we're wrapping up today's market domination. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned.
There's the closing bell on Wall Street, and now it is market domination overtime. So let's see where the major averages ended on the session. Near the lows, not quite all the way at the lows, but near the lows for the major averages here. The S&P 500, the Dow, I should say, off almost 410 points here, down about 1%. The S&P 500 off by 1.7%. And let's get another look at that stat for the week, down 3.2%, or even worse than that when you date it from Friday's close here. The steep decline that we've seen, looking like the worst weekly performance going back to March of 2023. For the Nasdaq, its worst weekly performance going all the way back to 2022, and off a steep 2.5% or so on the session. Of course, all of this has to do with the jobs report that we got this morning. Even though the unemployment rate did tick down to 4.2%, non-farm payrolls coming in lower than estimated and raising concerns about the state of the labor market. But in addition to all of that, what really hurt, if you will, during the session was the sell-off that we saw in technology in particular. Remember when tech would welcome the news of lower rates? Well, we're a far cry from that, aren't we? Because we are seeing this really just so much red on your screen. I'm going to equal weight it here just to give you, a scant dozen of stocks in the Nasdaq 100 were higher today, and many of those were down. That were down the most were some of the biggest names. Broadcom down 10% after its earnings. Tesla off by more than 8% on the session as well. Nvidia down another 4%, adding to the selling that we have already seen. And getting to the sectors overall, as we pointed out earlier, some of the defensive groups were doing either better or less worse, depending on how you look at it. So, for example, consumer staples only down about 1%. Real estate pretty much unchanged here, but tech, consumer discretionary, communication services deeply into the red, Josh.
All right, Julie, for more on the market action, let's get now to Fort Pitt Capital Group Chief Investment Officer Dan I. Dan, it is good to see you. Let's just start with that news today, Dan. Interested to get your reaction to that jobs report and what you made of the market's response to that report, Dan.
Yeah, hi. Happy Friday, and thanks for having me. I guess I didn't expect as negative of a response from the market, given that we had kind of, softened up going into the quarter. But, I think really what we're seeing is that we had this, pretty big wall of worry build up at the beginning of August after the sell-off, and markets probably climbed that wall of worry a bit too fast. I think sentiment and investor positioning may have gotten a bit too bullish too quickly. So we've got to walk some of that back.
What is your outlook, though, Dan, when it comes to what we're looking at now in terms of the economic backdrop, in terms of the labor market, in terms of the Fed's now expected approach to that? Is that sort of a more dour backdrop for stocks right now?
Well, I do think we're seeing some pretty clear signs that the economy is slowing down and the labor market is softening. But I also think it's really important for investors to take a bit of a step back and realize that this is kind of the last leg of the normalization process, right? So we don't get past the inflation problem or normalize inflation or be in a position where the Fed can normalize interest rates if the economy is still growing at 3+%, if consumers are still spending with reckless abandon, and we're still adding 250, 300,000 jobs to the payroll. So, we think it's the last leg of the normalization process that, frankly, needs to happen. But we also expect, a more even contribution to the earnings picture going forward across different sectors. And assuming that the economy holds up, we expect that to carry into 2025 as well, and for that to create a pretty solid backdrop for the broad market and well-diversified portfolios.
So you're going where I was headed, Daniel. As the economy cools, the labor market cools, what are your expectations for corporate profit growth looking ahead?
Well, I think it's probably a bit too early to write it in stone. But, if we look at estimates for 2025, right now they're hovering around 15%. And again, I think the composition of those estimates across sectors is extremely important as well. If we look out to next year, it shouldn't be just technology really driving the bus when it comes to earnings growth. It should also be, sectors like healthcare and industrials that are really recovering and starting to lap easier comps going forward.
And Dan, I know that you like healthcare. You have liked healthcare. You guys have been overweight there. Just broadly speaking, do you view it as a defensive play to some degree here, or just sort of a steady grower, perhaps, if you will?
I would say a combination of both of those things. We get into rough economic environments, and we do have the defensive safety characteristics of healthcare. very positive long-term, demographic fundamentals. And again, I do think it's one of those sectors that really is coming out of that post-COVID normalization process in a lot of areas, especially life sciences, which is a part of the healthcare sector that we really like. So, I think the tide is starting to turn, and healthcare is certainly acting a lot better than it did in the first 4 months of the year.
All right, Dan, good to see you. Thanks a lot for joining us. Well, stocks are racing earlier gains on Friday as investors digested a crucial jobs report that provided clues to the size of this month's expected interest rate cut and the resilience of the economy. The economy, of course, adding 142,000 jobs in August. That trailed expectations. Prior month job growth was also revised lower as the labor market showed signs of continued cooling. The unemployment rate, however, did tick back down to 4.2%. As you might know, we're coming down to the wire in a presidential election amidst all of that. Here to tell us what this report means for both presidential candidates and the guy currently living in the White House is Yahoo Finance's Rick Newman. So what are the implications?
Odd things are happening. I mean, it's been a little bit of an opposite economy in the post-COVID world. So you just talked about the wipeout in the stock market this week. I mean, the stock market has had indigestion for the past 2 months. Even though the stock market got the jobs report it wanted, just a little bit below expectations, it cements that Federal Reserve interest rate cut, probably just 25. We're going to start gradual cutting. But there's a weird thing happening when you look at all the consumer confidence metrics, which is that consumers are feeling better, not worse. And Oxford Economics put out a note today declaring the vibe session is over. So why would ordinary people be feeling better as the labor market is softening and everybody's 401k plan has been going down for the last couple of weeks? I guess it's because inflation is just not really a problem anymore. People are just not thinking about it. I mean, we've been talking about this a lot for much of the last year. Inflation has been coming down, but people have remained very, very gloomy. So maybe what's happening is the inflation fever is breaking. So to put this in the context of the election, probably this is exactly where Kamala Harris would like to be. I mean, she is the de facto incumbent. And when you see confidence improving in the last 2 weeks prior to an election, I guess people think prices are finally stabilizing. They're probably getting the message that interest rates are coming down. So borrowing for a mortgage, borrowing to buy a car, it's going to get a little cheaper. But you got to wonder, if as the job market softens up, when is this actually going to start impacting confidence? I don't know if it'll be during the next 8 weeks before Election Day. I don't know if it'll be before Inauguration Day, but it seems like that might be coming.
Do we know, Rick, how people are feeling as it breaks down along ideological lines, meaning are Republicans, Democrats, Independents, is everybody feeling better?
Yeah, it's really interesting because there is definitely a partisan element to this. I mean, it's hard to understand why exactly because, the economy does what it does. I mean, it's not like Kamala Harris replaces Joe Biden as the Democratic candidate and suddenly, inflation falls by 50 basis points or something like that. But when Kamala Harris took over, economic optimism among Democrats went up considerably. I mean, it was not a statistical blip. I mean, it clearly went up. And as it looks more likely that Kamala Harris could become the next president, Republican confidence on the economy goes down a little bit. So yeah, there absolutely is a connection with politics here. I suppose it didn't used to be that way, but I guess even everything about the economy even is politicized these days.
And finally, Rick, I want your take on U.S. Steel. Very popular talking point on the campaign trail among the candidates, among Biden. What's going on there, Rick?
Yeah, I dug into this and just published a story on this. This is totally political that Joe Biden, the president, Kamala Harris, the Democratic nominee, and Donald Trump, the Republican nominee, all oppose this purchase of U.S. Steel by Nippon Steel. The broad context here is Cleveland-Cliffs, which is another domestic steel company, offered about $7.3 billion for U.S. Steel last year. And Nippon came along and basically offered double that, more than double. So almost $15 billion, obviously a better deal. But all these candidates have come out and said, no, this cannot happen. And what's probably going to happen soon is the official mechanism for this is this kind of secret-y group that nobody knows about called CFIUS that approves foreign purchase of U.S. companies. It has to say, yeah, we're comfortable with the national security implications. And it sounds like what's going to happen is Biden's CFIUS, which is chaired by Treasury Secretary Janet Yellen, is going to say, we have some national security concerns here, so we're going to block it. That's pretty silly. Japan is a close ally. There really are no national security concerns. So the steelworkers have opposed this all along, and Biden is basically doing what the steelworkers want, which is he's giving cover to blocking this deal. So what's going to happen? I mean, Nippon could walk away. They could say this American way of doing things is ridiculous. It comes down to steelworker votes in the swing state of Pennsylvania. But it's also possible that there's some change in the offer. And that the steelworkers say, okay, we finally got better guarantees on job security and things like that. So maybe we're okay with it. I don't think there's any chance that's going to happen before the election. I think it could happen after the election, and that might be the game the steelworkers are playing, is just use the votes in Pennsylvania to get the best possible deal they can under cover of President Biden and Vice President Kamala Harris.
Well, and Rick, I guess the question is, how much time does U.S. Steel have? Because the CEO of the company has been out saying, if this deal doesn't happen, we don't have enough money to keep all of these plants open. I guess the question is, how long can they keep things going at this rate before the deal would need to get done?
And he also says, we're going to have to move the headquarters from Pittsburgh we're going to have to move the whole operation basically to the South, where we aren't going to have to deal with labor unions. So, assume there's some bluffing in that. But my guess is, no one is saying this publicly, which is why I dug into it. But my guess is everybody knows the game here. The Steelworkers Union, they're smart and savvy. They know what's going on with the election. The management at U.S. Steel knows what's going on. Nippon Steel, I don't know. I mean, they could lose patience with this whole thing. But, for sure, U.S. Steel can hold on another 2 months and see if they can get a different outcome once this election is over. I'd put it at maybe a 30 to 40% chance this deal does go through once the election is over, because once the Steelworkers Union, it's got leverage now, but that leverage diminishes after the election and all the votes are in Pennsylvania. So there are no real good fallback options here if Nippon doesn't buy this company.
We'll see what happens. Thanks for covering it for us, Rick. Appreciate it.
Bye, guys.
Coming up, a big week ahead for markets, the economy, and the consumer. From a fresh inflation reading to Apple's new phone, we've got everything you need to watch in the week ahead. More Market Domination Overtime coming up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
The artificial intelligence boom has brought this to the spotlight. Demand for data centers. Tract, a developer of data center parks, is increasing its skin in the game with plans to host one of the nation's largest data center complexes. Tract anticipating up to 20 million square feet of data center space across as many as 40 individual data centers. For more on this bet on AI, let's get to Tract CEO Grant Van Rooyen. Grant, thanks for being with us. So you buy the land, you put the infrastructure in, and you hope that somebody's going to come put a data center park there. How do you figure out where that should be?
Well, thanks for having me, Julie. It's a pleasure to be on with you and your viewers. The first thing is, we've announced now 4 transactions. The latest one was in Phoenix. It's 2,100 acres, contiguous development. And we engage in all of the complicated and hard to do deployment of infrastructure. We locate these campuses where we can deliver electrons. Power is critical to data centers, as is wet infrastructure, water, sewer, roads, and we prepare these sites such that our customers, the hyperscalers, can move with speed and certainty and come in and deploy their data centers and be able to respond to the demand signals that they're seeing for their services. In Phoenix's example, it's a top 2 or 3 absorption market for data centers in the United States. It's a fabulous market, robust demand trends, and those are the types of markets that we've been deploying our capital in.
Who are your customers, Grant?
Josh, look, our customer base is primarily the hyperscalers, those like Microsoft, Amazon, Google, Meta, Oracle, NVIDIA, and others, those that are looking to build these facilities, data centers, and house their server equipment so they can provide services to their customers. Those are our primary end users relative to this infrastructure.
Now, traditionally, Grant, some of these data centers had to be located in cold places, in part because of the cooling that was employed. Now, the technology has changed and advanced a little bit on that front. So, this area we're talking about is in Arizona, which I don't think of as a cold place. I guess at night sometimes it's a cold place, but in any case, talk to us about how geography is also informing where you guys are looking.
Sure. I think the concept of data centers only being located in cold climates is a bit of a misnomer. Data centers have been deployed for a long time in every climate. There are different solutions to navigate the cooling requirements, but we have the capability and the technology today to deploy data centers in a multitude of climates, including hot climates like Phoenix. The primary drivers of location are the consuming eyeballs. At the end of the day, the data, the information that's being consumed or generated out of these facilities is being consumed by human beings. And that means latency matters. And so having these workloads and this information located proximate to population centers and being distributed such that there's redundancy as well is very important. And so if you look at across the United States, for example, there are data centers located near all the population centers. And certainly the hyperscalers now are running a 12 to 15 market fabric at the market level for their infrastructure. And we think there'll be incremental capillarity of those deployments relative to improving performance and locating these facilities closer and closer to population centers and the ultimate consumers.
Yeah, Grant, we just got a big jobs report today. I'm curious, are you all able to find all the workers you need to get the job done?
Look, Josh, I'd say that's one of the challenges going forward. The United States doesn't have enough industrial land, first and foremost, and we don't have enough skilled workers. If you look out over the next 10 years, the U.S. needs another 300,000 electricians, for example. So there is a massive opportunity for incremental jobs growth driven by the data center use case. We've been fortunate thus far that we and our industry has been able to find the talent and train the talent. But as we continue to grow our industry north of 15% for the next 10 plus years, that challenge is going to get bigger. But it also presents a wonderful opportunity. These are high-paying jobs. These are skilled workers, and they're durable jobs. And so we think that if we all plan over the long horizon, which is one of our critical aspects, if you think about our developments, they're at least 1,000 acres. What we announced in Phoenix is over 2,000 acres. That's a 10-year construction project for 2,000 skilled men and women working on site just to build the facilities for 10 years. And so there's a good job story in here, but we have to be planful, and we have to put those resources in place and train and prepare for it.
Grant, obviously there's been a lot of growth in this area. At some point, do you think it slows down as we sort of move into the next phase of AI, where you're seeing less training, more inferencing, or is it still, this is going to continue, as you said, for the next decade at the same kind of pace?
Yeah, Julie, look, we think that the demand trends are not only durable, but they're accelerating. And we think it's still very early innings. And whether it's training, inference, or the traditional public cloud use case, all of those product sets, if you will, are in their infancy and or are early innings. And so we do think that this demand is durable. We think and we think there is a use case or a case to be made for incremental acceleration. If we've been growing at 15% in the aggregate, we think there's the potential for that to accelerate beyond, which is going to mean we need more and more of these facilities, and we need them at ever larger scale. To put it into context, 5 years ago, data centers were consuming 10 to 20 acres. Today, they're hundreds of acres, and tomorrow they're going to be thousands of acres. And that puts incremental pressure on where you can locate data centers and how you need to change the planning horizon to be able to curate and gather that magnitude of infrastructure in one place. And so that's why we plan over a very long period of time. But we think the demand side of the equation is very healthy, and it's likely to stay that way for a long time.
Grant, thank you so much for joining the show today. Have a great weekend.
You too. Thanks for having me on.
Time now for what to watch next week. Starting off on the earnings front, we'll get some big earnings next week, including Oracle and Adobe. Oracle reporting first quarter results after the bell on Monday. Analysts expecting the company to meet Wall Street estimates and for its cloud infrastructure sales to get a boost from AI.
Looking at big tech, Google back in court on Monday with the Department of Justice, this time to argue about the company's alleged monopolistic behavior over how ads are bought and sold on the internet. Plus, in big tech, Apple is set to unveil the iPhone 16, which will be the first to feature Apple Intelligence. That's the tech giant's foray into AI. And the phone isn't the only product to expect. Apple could also unveil a new slate of watches and AirPods.
And moving over to the economy, the latest CPI print, that's the Consumer Price Index for August, coming out on Wednesday. Economists forecasting those numbers to hold steady at 0.2%, giving us more insight into the health of the consumer.
And in addition to CPI, we'll also be getting the latest Producer Price Index data for August on Thursday. Total PPI expected to stay at 0.1% month over month. We're not worried about those numbers anymore.
No.
We're worried about the numbers that came out today. All right, that'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. And for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. A tough week for markets. Investors digesting the weak jobs report and fleeing tech stocks. The S&P 500 posting its worst week since March 2023. Plus, gearing up for Apple's big day, the tech giant set to unveil the iPhone 16, which will be the first to feature Apple Intelligence, the tech giant's foray into AI. And the phone isn't the only product to expect. Apple also expected to unveil a new slate of watches and AirPods. And the NFL season officially underway. We're taking a closer look at the growing business of betting with DraftKings CEO Jason Robbins. U.S. stocks did close lower to end the week in what has been a volatile start to September. And Yahoo Finance's Josh Schaefer joins us now with more on the trading day takeaways. Joshua.
Hey, Josh. Yeah, so the S&P 500 having its worst week since that regional banking crisis in March of 2023. The Nasdaq having its worst week since 2022. And I want to just start there. I mean, if we're going to talk takeaways from the week, it was a lot of red. And I want to just take a look at sort of what we saw. We'll put this on a 4-day because we had a holiday shortened week. Nasdaq down almost 6%. The S&P 500 down over 4%. And when you really take a look under the hood here, Josh, we'll go to the heat map and we can see where the selling was. It was in tech, right? Take a look at XLK here, down 7% over the last 4 days. And we'll look at our big one like we always like to. We'll take a look at the Nasdaq 100. Look at NVIDIA, down almost 14%. You're seeing a clear trend here of where the
Broadcom, 16.
Broadcom 16, and that was an interesting one, Josh, because it felt like, well, if Broadcom has positive earnings, if they're able to maybe surpass the revenue guidance the street's expecting, does that reinvigorate some of the AI trade?
That was out there in the bloodstream, for
And
sure.
we did not get that. And so you just saw more selling, and it's just been a hardcore rotation out of tech. Jobs report didn't help that either. And right now, I'm sort of just wondering what can stop this, right?
Yeah. Well, Joshua, it's Friday. We're heading into the weekend. People are watching. They're long the market. You got to give them something. I mean, give me some light at the end of the tunnel.
Yeah. So we'll take a look here, Josh. This is an interesting graph. It's light at the end of the tunnel and also perhaps not. It's mixed. But we like mixed, right? So what we're looking at here is data from FactSet. This is earnings estimates for the current quarter. Analysts always slash earnings estimates in the first 2 months. It's typical, right? So we're looking at 2.8% here. What's the sort of the takeaway that's positive? They always slash. And it's not as bad as it's been in the past. The average is 3% over the last 20 years, so we're a little bit shy of that average. But I did think it was interesting today. Citi's Scott Kroner, at the head of equity strategy over there, said, right now, earnings are looking a little bit uninspiring. Remember, last quarter, we had estimates not get slashed. So that was when we felt a little bit better. You had that 0.3 there. So maybe the positive will be if people start feeling a little bit better about earnings going into earnings season in October. I don't know, Josh, maybe there'll be something from the Apple event on Monday that gets people excited about
Usually
AI
not
again.
a big stock mover.
Right.
We've been talking about it so much.
But maybe something to just reinvigorate a little bit of that optimism. But to be honest, right now, we're in September, seasonally not a great month. You have debate over the Fed. You have the election coming. It feels like we're going to be in chop for a little bit.
You could maybe just churn here for a bit.
That's what it feels like. And I want to go to take two, which is, of course, the rate cut debate, right? So we had the jobs report this morning, and what you saw, that sort of some key takeaways here, you had non-farm payrolls come under, unemployment rate fell, but from 4.3 to 4.2. But if you look at the rounding, it really wasn't that great. And then overall, we saw markets kind of shift to, at one point today, Josh, we were pricing in a 60% chance of a 50 basis point cut. Now we're down to 31% after the Fed speak. It feels like this might be contributing to the market mood right now too, that 50 bips cut is just not coming in September. And then you start to worry about is the Fed offsides, is the Fed not offsides? But maybe there's a chance this can move again, right? We still have 2 weeks until the Fed meeting.
And then we've got that CPI print next week. How important is that for the market?
Yeah, Wells Fargo had an interesting comment on this, Josh, saying that they think that if we have a better than expected CPI print, so core CPI is expected to rise 3.2% year over year, maybe if that number comes in a little bit lower and the Fed can feel even more confident about inflation, then maybe this goes up and the market starts feeling like the Fed can cut 50 basis points in September. So it'll be interesting to see if inflation keeps trending maybe even better than the Fed thinks, then maybe they can give some help on the labor market side there and do a larger cut.
All right, we'll be watching. Thank you, Joshua. Moving on, it's that time of year again. No, we're not talking about back to school, but instead, it's Apple's annual event to show off a new iPhone and a slew of other products and upgrades. Here with a preview of what we can expect Monday is Lisa Edichico, CNET Senior Editor. Lisa, it is good to see you. So listen, if you're an Apple fan, you're an Apple investor, this is just one of those days you got marked on your calendar, Lisa. You expect CEO Tim Cook to take the stage, introduce some new products. What are you going to be looking for, Lisa? What do you expect to hear?
Yeah, absolutely. So the biggest things we're expecting to see are definitely the iPhone 16 lineup. That's probably going to be the star of the show. But we're also expecting to see 3 new Apple Watches. That's according to a report from Bloomberg this morning, and some new AirPods as well. But I think the big question on everybody's mind is going to be, how does Apple Intelligence play into all of this? We got like a preview of Apple's AI plans back at WWDC in June. And I do feel like this September event is going to be where we kind of see how those plans will come into play in the future.
When we talk about these new AI features, Lisa, for folks who don't follow this stuff as closely as you do, what are we talking about? How are these features going to really improve the user experience?
Yeah, absolutely. So it's hard to say how impactful they will be until we actually use them, since they're not out yet. But in terms of what Apple has shown, there's going to be new tools for rewriting text messages and emails, summarizing text messages, a new version of Siri that's more contextual and knows more about your personal information so that it can answer more personal questions and things like that. So I think it'll take some time for consumers to warm up to these features and kind of see how they fit into their lives. CNET actually did a survey with YouGov to see how people feel about AI features. And it turns out that 25% of respondents actually don't find them very useful yet and aren't interested in getting more AI features on their phones. So I do think this is going to be something that consumers will have to warm up to over a long period of time. I don't know if it's going to be a driver for upgrades. I do think people continue to look at battery life and camera quality and things like that. But yeah, it'll be interesting to see what Apple has to say on Monday.
Would you expect all those usual bells and whistles too, Lisa? I mean, the faster processor, the better camera?
Yeah, absolutely. So especially for the Pro models, we're expecting to see larger screens and a new dedicated camera button. So if you want to take a picture, instead of having to press that button on the screen, the reports say that there's going to be an actual physical shutter button, more like a regular camera. So that'll be interesting. And we are expecting to see new processors, because Apple usually refreshes its new phones with new chips. And that's going to be really important for some of these new AI features as well.
You think they raise prices, Lisa, for these new models?
It's really hard to say. So we do have an idea of how much Apple usually charges for new iPhones. Usually the cheapest model starts at about $800, whereas the Pro Max starts at like $1,200. But it's interesting because we have seen other companies like Google and Samsung raising the prices of their phones. So it's hard to say if Apple will follow the same route. It's possible that maybe these new AI features require more computing power, and maybe that's contributing to some of the price hikes we've seen. But yeah, it's hard to say until we know for sure on Monday.
You know this industry so well, Lisa. You know, these new AI features that Apple is introducing here, rolling out, are they markedly different than what some rivals already have? I'm thinking the likes of the Googles and Samsungs.
Some of it's the same and some of it's, or similar, I should say, and some of it's different. For example, I think Apple's approach, based on what we've seen, is more contextual. It's more about kind of connecting the dots between the different apps on your phone and kind of using Siri as a way to do that. But then there are also some other things that do feel similar to features we've seen from Samsung and Google, like the ability to, generate an image based on a sketch or rewrite text messages in a different tone and things like that.
Finally, let's talk about the wearables too, Lisa. What should we expect, watch and AirPods wise?
Yeah, so a report from Bloomberg indicates that there will be 3 new Apple Watches at this event: a new Apple Watch SE, the Apple Watch 10, and the Apple Watch Ultra 3. Now, it's really that second one that I think is the most interesting, the Apple Watch 10, because we're expecting a little bit of a redesign. And then in terms of AirPods, we're expecting to see a new version of the entry-level AirPods and the mid-tier AirPods that will kind of bridge the gap between that middle-tier model and the Pro models as well.
You think there's a chance, Lisa, we get one more thing, we get the surprise, or the reporting is just, it's too good now. It's very tough for a surprise to come through.
I do feel like it is very tough for a surprise to come through. A lot of the reports that we see from Bloomberg, the predictions that we see from certain analysts like Ming-Chi Kuo, do tend to be very accurate. So I do feel like we have a good idea of what to expect. But what we don't know is how Apple will present it. And of course, there's always a chance that anything could happen. But it'll be interesting to see exactly where this goes. But I think for sure we know we can expect some new iPhones.
Lisa, we'll all be watching. Thanks so much for joining the show. Have a great weekend.
Thanks for having me.
Stick around. On the other side of the break, I'm speaking to the CEO of DraftKings, Jason Robins, to discuss the latest betting trends as the NFL season kicks off.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
The NFL is back as football season kicks off. So too does sports betting. And joining us now is DraftKings CEO Jason Robins. Jason, it is good to see you. And I want to start right there. The NFL is back, Jason. So walk us through what this means for DraftKings, your company, your business.
Well, this is our holiday season, so to speak. It's the best time of year for new customers to come in, reactivation, and it starts really the biggest time in terms of overall betting, especially as the MLB playoffs come together, the NBA season, NHL season starts. It's really a great time of year. So we're very excited, and it was off to a really good start last night with Thursday Night Football, and hopefully we'll see a great weekend as well.
And Jason, for investors listening right now, what they're dialed into is those customer acquisition trends, Jason. So I'm curious what those trends do look like, this year versus prior years. What can you tell us?
Well, it's a little early to tell. I think we'll know more after the weekend, but we've been seeing really strong customer acquisition leading into the season. So I think we expect to see continued strong customer acquisition, but a little early to be able to say for sure. Definitely, it's a very, there's a lot of momentum right now, I think, in the industry. And I think as one of the leading operators, DraftKings is benefiting from that, but also the team has done a fantastic job building a great product and putting great marketing plans together. Really, this season, we're emphasizing touchdowns. DraftKings is going to be the best place to bet on touchdown scores all season long. We're going to have the most promotions and the most markets set up around touchdowns. And that was off to a great start last night with some big touchdown scorers, with Derrick Henry getting that first one.
Let me ask you, just to drill into customers a bit more, Jason. You think sports betting, your typical customer, 35-year-old male, is that changing? Is that evolving at all?
Definitely more and more women are starting to join the platform. We're seeing that. Average age has stayed pretty steady, kind of early to mid-30s, but we're seeing more and more women join the platform, which is great.
And why is that, Jason? Why do you think more women are joining the platform? Is it for the same reasons or different reasons than the men?
I think it's largely the same reasons. We've also been seeing a huge increase in betting on women's sports. That's coming from both men and women, so it's not like disproportionately one way or the other. And women are, as you imagine, betting the most on the most popular sports like NFL. So I think it's really for largely the same reasons. It's a product that many people find enjoyable if you like sports, and more female sports fans are getting into it.
Let me ask you, Jason, you all have been making some moves, making acquisitions, Simple Bet, Jackpocket, right? I'm just curious whether you all think you all have everything you need now, everything in the stack to really help you attract and retain those customers.
I definitely think we have everything that we need right now. Obviously, it's a very rapidly evolving industry. Technology moves quickly, and so over time, we'll always be assessing that. But we feel pretty good about the capabilities we have now. I think Simple Bet will be the last piece of the pie. But again, that'll change over time. We're not a company that rests on our laurels. We always keep moving, always want to stay ahead of whatever the next innovation might be. And I think it's important to think about doing that not just through M&A, but also through curating and growing incubations of ideas and things in your own shop. So that's something we're also very focused on doing, and something that's produced a lot of great results for us as well.
The market is evolving, Jason, obviously. You and FanDuel's the giants in this space. You talk to analysts, though, and they'll look at other players, in their words, the kind of the tier 2 players. So Penn, ESPN, Fanatics, Caesars, BetMGM, and they'll point out, Jason, those players have been making moves as well, changes, tweaking their models. Are they going to be bigger competitors this NFL season?
Well, we'll have to see. I mean, I think we've had a lot of waves of competitors, and we feel like we've held up pretty well and have continued to gain share throughout all those periods. And my expectation is the market will further kind of consolidate, but it also depends on what all these companies do. As you said, they're making their own moves, and we'll have to see. We view it as we're competing with a number of different companies every single day for the customer, and we have to do the best job of all of them. And that means that it's, we had to both stay on top of those that are already established, like FanDuel and BetMGM, as well as some of the smaller up-and-coming ones that you mentioned. So I think that's really important, and you have to realize innovation can come from anywhere, and if you don't stay ahead of all of your competition, then the customer is going to find out.
Jason, another issue I wanted to get your take on, got some attention, obviously, when you said you would introduce this surcharge on consumers in states where taxes on sports betting were higher, and then reversed course there. What did you learn about that process, Jason?
Well, I think it was an example of where we were very thoughtful about how we approached it. We threw an idea out there. We said we did not intend to implement it for quite some time, not until next year. And that was really an opportunity for us to hear from our customers and see what they thought. And after carefully considering their feedback, we decided that wasn't the best course of action right now. So I think it's a great example of the company taking a shot, but also understanding that you have to do it in a way where you have an opportunity to listen to your customers, and if it's not necessarily received in the way that you had hoped it would, then you can always change course. And I think we set ourselves up well to do that here. And as I said, we always focus on the customers. So if our customers like something that we're doing, then we're going to double down on it. And if they don't, then we're going to go back and try to find other solutions to the problem.
Jason, final question. Sports betting, it's legal now in a lot of this country. 2 holdouts, Texas, including Texas and California. I'm curious what you all at DraftKings are doing to just push legalization forward in some of these markets.
Well, it's great, first of all, that already half the country in just 6 years has chosen to legalize and regulate this. And I think it's been a huge success story in the states that have. Not only has a tremendous amount of tax revenue been generated, but also the illegal market has really been damaged, and so many more consumers are being protected now, and protections from minors are in place. So that's all a really good story. That said, I think, the first half of the country is always probably going to be a little faster, and I think the last half will probably be a little slower, but I do think inevitably most states will end up having this. That's my belief. I just think that the benefits are too great, not just, again, from the tax perspective, but in terms of protecting consumers and taking an activity that people are doing anyway and bringing it into a regulated market where they know that they can trust where their money is and they know that they can trust that they'll be paid.
Jason, thank you so much for your time today. Enjoy the games this weekend.
Thank you so much. You enjoy them too.
we are looking at the pace of job gains in the U.S. and how the 3-month average is below the margin of error. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, let me explain here, Josh. So as we know, we just got the jobs numbers for August this morning, coming in at 142,000. Let's see if I can write that on there. I can't, but you know what it was, 142,000. In July, we had a lower revision to an addition of 89,000. And June also was revised down, in its case, to 118,000. So if you're looking at now the 3-month trend, you come up with this line here, the blue line, 116,000. That's just the average of these three. But as Omar Sharif of Inflation Insights pointed out in a note that was published by Sherwood, if you look at some little notes on the Bureau of Labor Statistics page, you'll see that there's a rather large margin of error of about 130,000. So we are below that threshold here. Basically, the bottom line is this. There are frequently revisions, and then these are, in the words of Claudia Sahm, who we spoke to earlier today, these are imperfect measures. But she said best not to focus on any one month, on any one number, and rather look at the larger story. Here's what she said.
There is no magic number, right? And to make policy or to make an assessment of the U.S. labor market or economy in general, you have to look at lots of different pieces of data. And yes, being very aware of these are imprecise numbers and they will change, but you got to kind of high level.
You kind of high level it and look at it from that bigger picture view, as she does with the SOM indicator named for Claudia. She came up with it. It's based on the unemployment rate, but it's change over time. It's more about the magnitude of change and the velocity of change over a given time. But Josh, one of the reasons that this caught my eye today is because you have been talking about revisions lately. And so then when this issue came up, I said, oh, this is very interesting, because not only do you get revisions, but you got this big margin of error.
Yeah, it was so interesting to listen to Claudia Sahm there, Julie, and I always appreciate the chance to have her on the show. And when we were talking with her, I think it's fair to say she was, in the cooling, not crashing camp. But when an economist of her stature tells you, as she did tell us, the direction we're headed in, she said here, is not positive, you pay attention to that.
Yeah, most definitely, because the numbers she is looking at a high level are showing indeed that we are seeing that pretty dramatic cooling here.
Yep, Julie, thank you so much. And that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.